Buying the same size in a calm melt-up as you do in a full-blown panic is like wearing the same clothes in July and January. The market has weather. Most homemade bots are completely blind to it. They size a trade in a crash exactly like they would on a quiet Tuesday. So I gave mine away to check the forecast first. I'm Sandbox Theory. I'm building a hedge-fund-style trading system on my own. US large-cap equities, paper traded through Alpaca, human confirmation on every live order. So far, you've seen the survival layer and the learning loop. Today, awareness. I'm going to show you the regime gate, the part that reads the market's mood and adjusts how much risk the system is willing to take. And this is the episode where I actually get to show you validation numbers from a backtest on real market history. I'll put them on screen, I'll label exactly what they are, and I'll tell you what they don't mean. Let's go. A regime is just the market's current character. Is this a calm, trending, forgiving environment, or a jumpy, falling, punishing one? My system sorts the world into 3 buckets: risk on, neutral, and risk off. And it doesn't guess. It reads a couple of specific things. First, the realized volatility of SPY, how violently the broad market has actually been moving lately. Not a forecast, not a vibe. The measured size of recent moves. Calm tape and thrashing tape are genuinely different worlds, and the system can tell them apart. Second, SPY's 200-day trend, the long-run direction. Are we broadly above the tide line or below it? Plus some macro inputs on top. Put the volatility and the trend together and you get a read: sunny, mixed, or stormy. That's it. Deliberately simple. I'm not trying to predict the weather next month. I'm trying to correctly notice the weather right now, because that alone is enough to make a better decision than pretending every day is the same. So what happens when the gate reads risk off? 2 things automatically. New positions get sized smaller. The system takes less risk per new trade when the environment is dangerous. And the hedge's net beta target comes down, meaning the whole book is steered to lean less on the market's direction. In plain terms, when the weather turns, it takes chips off the table and stops betting so hard that stocks keep going up. Here is the single most important design choice, and I want it burned into your memory before I show you any numbers. The regime gate can only ever shrink exposure. That's it. It is not allowed to make the system more aggressive. There's no risk-on setting that says, great, leverage up. The best case is it leaves things alone. Its entire job is to take risk off when the weather is bad, never to add risk when the weather looks good. And there's a fail-safe underneath it. If any of the data it needs is missing or looks broken, bad feed, stale number, whatever, it doesn't panic and it doesn't guess. It defaults to no change. A data problem can never cause a surprise move. The safe failure is do nothing, and that's exactly what it does. Now the part I promised. I ran this against roughly 6 years of real SPY history to see whether reading the weather actually helped. And I want to be careful with these numbers, so read the labels on screen. This is a back test. It is not a live track record, and it is not a promise. 2 things improved. Maximum drawdown, the worst peak to trough drop, the deepest hole the strategy fell into, went from minus 24.5% to minus 18.9%. That's a meaningfully shallower hole in the bad stretch, which is precisely when it matters. And the Sharpe ratio, a rough measure of return per unit of risk, how much bumpiness you endured for your result, went from 0.83 to 0.93. Higher is better. It means smoother reward for the risk taken. Here's why I like this result, even though the numbers are modest. The gate never tried to boost returns. It only ever shrank risk in bad weather. And that alone improved both how deep the hole got and how smooth the ride was. That's why I call it one of the cheapest risk improvements available. It's a small, conservative change with no new leverage and no fragile prediction, and it still moved the numbers the right way. The honest part, and I mean this. A backtest is a story about the past, told by someone who already knows the ending, me. 6 years is one span of history. It includes the conditions it includes and not others. A regime that shrank risk at the right times in that window might be a beat late in the next crash, because it reacts to what has happened, not what's about to. And these are paper, back-tested numbers. Minus 18.9 and 0.93 are not guarantees. They're evidence from one simulation. So I don't present this as, look how much better. I present it as, a simple, fail-safe change that can only reduce risk, improve 2 risk metrics in a 6-year backtest. That's a claim I can stand behind. Anything bigger than that, I can't, and I won't pretend otherwise. The regime classifier and the sizing logic are in the repo, linked below, if you want to see how the buckets are actually drawn. If you appreciate a channel that labels its numbers and admits what they don't prove, subscribe. That's the whole brand. I mentioned the hedge a few times today, lowering a net beta target. Next episode, I get into that properly, how the system hedges its market exposure without ever touching an option. Because remember, this thing never trades options. So how do you hedge without them? That's episode 8.